mergers and acquisition. Okay, a review of mergers and acquisition for the SFM Dawn series. As you see on the screen, I have taken 8 questions of mergers and acquisition from the recent papers in RTP. And out of these, question number 2, question number 5 and question number 6 are new sums. And the other questions are those which are already there in our book. So let me do something. I'll put 2 classes of mergers and acquisition. In one class, let's discuss question number 2, 5 and 6. And in the second class, let's cover the remaining questions, even though they have been done in class, but because I consider them to be important. As far as the revision of mergers and acquisition is concerned, you know that mergers and acquisition is a very straightforward topic. In most of the sums, we take A Limited, which will acquire B Limited. So A Limited is the acquiring firm, B Limited is the target firm. Okay? And the merger would be viable only if it increases shareholders' wealth for A Limited, which means that shareholders of A Limited should gain as a result of merger. Of course, from the point of view of B, shareholders of B Limited should also gain as a result of merger. Now, how come both the shareholders can gain? The reason is synergy. There are various sources of value creation or synergy. For example, A Limited and B Limited belong to the same industry. Okay, they are competitors. So if they merge together, there will be avoidance of competition, there will be greater market share, there will be monopoly power. That's on the revenue side. On the cost side, they will have lower cost because of economies of scale. If we go towards a merger where different industries are involved, perhaps there could be complementary resources. There could be increase in efficiency because of better decision making. So there are a number of reasons for merger. Our syllabus in CA Final is always stressed on the maths as in the sums on merger. And when we do the sums on merger, then A Limited has to pay purchase consideration to B Limited. That purchase consideration can either be in the form of cash, so it's a cash deal, or it can be in the form of stock. Okay, stock deal. That means A Limited is issuing its own shares to the shareholders of B Limited. Most of the mergers are stock deal. Okay, but some mergers could be cash deal. Now, the synergy aspect which I was saying may not be present in the sum. Maybe synergy is not there, or it may be present in the sum. If it is present in the sum, synergy may be in the form of earnings. Synergy in earnings, that means earnings of the combined firm will be higher as compared to the sum total. But synergy can be in value. That means value of the combined firm will be higher as compared to the total of their pre-merger values. So synergy may not be there. Synergy may be in earnings. Synergy may be in value. Especially in sums on stock deal, we seem to apply the bootstrap effect. That is, P ratio will remain the same for the acquiring firm. That's a very, very unrealistic thing. That means acquiring firm A Limited has a high P ratio 20 times. It acquires B Limited with a P ratio of 10 times, and by what we call Jadoo, magic, when the acquisition takes place, the market applies a P ratio of 20 for the merged firm. It doesn't happen in real life, but in many sums, such is the situation. So there are several types of sums on merger, and they are very, very simple. There is no formula of standard deviation or beta or this or that. It totally syncs with the accounting background of CA students. And I've always seen that CA students have been able to handle mergers topic quite well. In fact, over the last 3-4 years, CA Institute has not experimented with mergers topic. It has given straightforward sums on mergers, generally repeated, and if new, the new sums have also been more easy as compared to the old ones. So this is a topic that should be tactically exploited, that you are able to score full marks over here. You cannot afford to lose marks over here. Let's move into the sums. So I'm going to the sums area. So this is the sums sheet. I'm going to question number 2, as I said. Okay, although question number 2 was marked as new, But I remember this is an old sum. This is an old sum, but it's a good sum because it involves valuation and many calculations. So if somebody does the sum, that person is able to get a hold over mergers quite nicely. Okay, let's do the sum. TK and SK are both in the same industry. Okay, same industry. There's lower risk in the merger. Former is in negotiation for acquisition of the latter. So TK is the acquiring firm. I'll call it A Limited. SK is the target firm, B Limited. Information about the two companies as per their latest financial statements are given below. Okay, here is the information, TK and SK. So number of shares of rupees 10 face value, 24 lakh, 12 lakhs. Debt. Okay, for TK Limited we have 10% debentures, 1160 lakhs. For SK Limited we have 12.5% institutional loan of 480 lakhs. EBITDA, earning before interest, depreciation, amortization and tax, 800 lakhs to 30 lakhs EBITDA. Actually in the sum depreciation is not given. They should have given EBIT over here because we are forced to assume that depreciation is nil. And how is it possible that depreciation is nil? So don't ask me that doubt. So I feel that they should have given EBIT to us so that that presumption would not have come. Market price is 220 for TK and 110 for SK. TK Limited plans to offer price for SK business as a whole, which will be 7 times EBITDA as reduced by outstanding debt. Okay, so what is TK going to offer to SK? 7 times EBITDA. EBITDA is 230. So I'm taking the calculator. 230 into 7. That's coming to 1610 lakhs. Reduced by outstanding debt, because 1610 lakhs is the value of the firm. Okay, because we took the EBITDA. EBITDA belongs to the firm, equity and debt both. So 7 times EBITDA is the value of the firm. We deduct debt minus 480. Okay, so 1130 lakhs is the purchase consideration. 1130 lakhs is the purchase consideration. I don't think you mind the fact that, sir, you are not writing. How does it matter? 7 times EBITDA, 7 into 480. Okay, and reduced by debt minus 7 into 230 reduced by debt means minus 480. That comes to 1130 lakhs. Discharged by own shares at market price. So we will issue our own shares at market price. What is our market price? 220. So if I have to pay 1130 lakhs, okay, in the form of shares worth 220, number of shares will be equal to 1130 divided by 220. 1130 lakhs divided by 220, that is 5.14 lakhs. Okay, 5.14 lakhs is the number of shares. 5.14 lakhs. SK Limited, the target firm, is planning to seek 1 share for every 2 shares based on the market price, because see, the market price of SK is 110 while the market price of the acquirer is 220. So 110 by 220, half is the exchange ratio. So they want 1 share for every 2 shares held, the target company. Tax rate is 30%. Calculate and show the following under both the alternatives. There are 2 alternatives now, TK Limited's offer and SK Limited offer. We have to calculate all this. So in the TK Limited offer, let me concentrate on the first offer. The net consideration payable was, we calculated that to be 1130 lakhs. You remember 7 times EBDIT, so 7 into 230 reduced by debt minus 480, that's 1130 lakhs. Number of shares to be issued is 1130 lakhs divided by 220, which is approximately 5.14 lakhs. EPS of TK Limited after acquisition. So for this purpose, we have to find out the PAT of both the firms. We are given the EBIDAT. So we need to deduct depreciation, interest, amortization and tax. But depreciation, amortization are not given. So forget about it. So we just deduct interest and make it post-tax. So for TK Limited, 800 minus 10% of 1160. Can you see that? Debentures is 1160. So 10% of 1160, 116. So 800 minus 116, I am doing it. 800 minus 116, that's the PBT, and that into 0.7, because 30 is the post-tax, 30 is the tax rate, into 0.7. So that comes to 478 lakhs. 478 lakhs is the profit of TK, profit after tax. Same thing for SK. This time the EBITDA is 230. We have to reduce the interest on institutional loan, 12.5% of 480. So let me do that. 230 minus 0.125 into 480. That comes to 170 lakhs, and 170 into 0.7 is equal to 119 lakhs. So 119 lakhs is the PAT of firm B. If I add both the PATs, the PAT of firm A was 478.8 plus the PAT of firm B is 119 something. So we get 597.8 lakhs. So 597.8 lakhs will be the total earnings of the combined firm, because it's not written that earnings will go up. Okay, 597.18 will be the earnings of the combined firm, and number of shares will be the 24 lakh shares of TK plus the 5.14 lakhs issued to SK. So 24 plus 5.14, that's approximately 29.14 lakh shares. 29.14 lakh shares. So if I divide the combined earnings, which is 597.8, divided by the combined number of shares, which is 29.14, I get 20.51. 20.51. Let me check the answers. 1130, 5.4 lakh shares, and 20.91. It's 20.51. They are getting 20.52 because I rounded off the shares to 5.14. It's 5,13,600 shares. Okay, that are issued to SK. Perfect. Fourth part, expected market price after acquisition. P ratio. So we got the EPS 20.52 and we should multiply by the P ratio, bootstrap effect, which I said just 5 minutes ago. So we have to find out the P ratio of TK. The price of TK is given 220. We need the EPS. So what was the PAT I got for TK? The PAT I got for TK was 478.8 lakhs and the number of shares is 24 lakhs. Divide by 24. Okay, so 19.95 is the EPS of TK, 19.95. So 220 divided by the EPS of 19.95. P ratio is 11.03 times. 11.03 times. So 11.03 shall be the P ratio after merger bootstrap effect, and that into the EPS, which we got that time 20.52. So 226.29 expected share price, 226.29 expected share price, 226.34 expected share price. Okay, post merger EPS into PE ratio bootstrap. Last part, straight briefly the advantages to TK from the acquisition. Now this is a merger of two firms in the same industry. So on the revenue side there will be avoidance of competition, greater market share, greater monopoly power, okay, pricing power, and on the cost side there would be cost reduction due to economies of scale and better coordination. Economies of scale and better coordination. So that's the theory question. So that was one part. We computed all this based on what TK Limited wants to pay to SK. Now let's come to what SK wants. So it's written SK wants 1 share for every 2 shares held. SK wants 1 share for every 2 shares held. So that means exchange ratio is 0.5. So number of shares to be issued will be 12 lakh into 0.5. That is 6 lakh. Can you see that? 12 lakh into 0.5, 6 lakhs. So total number of shares will be 24 plus 6, 30 lakhs. 24 plus 6 equal to 30 lakhs. That will be the total number of shares. 30 lakhs. Okay, 30 lakhs is the total number of shares. They are asking us to calculate the net consideration payable. So we are giving them 6 lakh shares and the share price is what? 220. So the net consideration payable is 6 into 220, which is 1320 lakhs. 1320 lakhs. So question number 1, net consideration payable 6 lakh shares at 220. 1320 lakhs. Number of shares to be issued 12 lakhs into 0.5, 6 lakhs. Okay, so we got two answers, 1320 and 6 lakhs. Let's check. 1320 and 6 lakhs. Next part, what is the EPS of TK after acquisition? So we got the combined PAT at that time. I think the combined PAT was 597.8 lakhs. Okay, so that divided by the combined number of shares, which is 30, divided by 30. So this gives me an EPS of 19.93. EPS of 19.93, is it? 19.93, perfect. Then they are asking what's the share price. So that into P ratio. P ratio was 11.03 into 11.03 equal to 219.79. 219.79. Yes, 219.23. That's the answer, market price. So it's a very, very simple question. But sometimes what happens, I've seen with many students in the exam, is that they can't do the simple sums. They do some silly mistakes and then they are asking for part marks. This is a very, very simple sum. You should be doing it exactly correct, and I am 100% sure you are not minding that I am doing it verbally, because you should also be doing that way. Now you have your calci and the pen ready. Why don't you do it this way? Correct? And if you want the written solution, it's given in a decorated manner by the institute. So question number 2 is over. I said I'll do 2, 5 and 6 in this class. So I'm coming to question number 5. Okay, question number 5. Let's see what is it all about. Yes, this is a new sum. It was done in class by me. Not this sum, but the topic was done in class by me as break-even exchange ratio or Con and Neelsen model. Okay, break-even exchange ratio, Con and Neelsen model. Although the institute does not use this word Con and Neelsen model, but this procedure is the Con and Neelsen model. What is it all about? It is about the maximum exchange ratio which A would like to pay, alpha, and the minimum exchange ratio which firm B wants, beta. How do we calculate the maximum exchange ratio that A can pay, alpha? What is the minimum exchange ratio that B demands, beta, if post-merger P ratio information is given? Post-merger P ratio information is given. Okay. Let's see. C Limited and D Limited are contemplating a merger deal in which C will acquire D Limited. The relevant information is as follows. So earnings are given 96 and 30. So 96 plus 30 is 126 post-merger earnings, if earnings are not going to go up. Number of outstanding shares 20. We can't do 20 plus 14 because total number of shares are never added. They are 20 plus the number of shares issued to firm B. EPS 4.8, 2.143, P ratio, price by earnings 8 times, 7 times, market price 8 into 4.8, 38.47 into 2.143, 15. What is the maximum exchange ratio, alpha, acceptable to shareholders of C? C is the acquiring firm. If the P ratio of the combined firm would be 7 times. Okay, P ratio of the combined firm would be 7 times. So what's the maximum that A can pay to B? So please imagine that you are a shareholder of firm A. So you are holding one share which is worth PA. After merger, you will be holding one share. We are denoting it by PAB, post-merger share price. Obviously, you will gain if post-merger share price is greater than pre-merger share price. But when we talk about break-even, you want worst to worst the post-merger price to be equal to pre-merger price. So PAB equal to PA. PAB will be P ratio into EPS. And PA I think is given. What is the price of firm A? 38.4. It's 38.4. 38.4. P ratio is given after merger in the question 7 times. EPS will be 96 plus 30 divided by number of shares. I think, let me check. 20 plus 14 alpha. 20 plus 14 alpha. Solve for alpha. Okay, we just have to solve for alpha. It's a very, very simple solution. Don't expect me to solve it for you. I will not. Okay, so we get alpha this way. The process followed by the institute may be different. Doesn't matter. You'll get full marks. But if you want to follow the process by the institute, move ahead. You can do that. There is no issue. For example, 96 plus 30 combined earnings into 7. That shall be the value of the firm. From the value of the firm, you deduct the value of firm A, which is 8 into 96. Okay. So you deduct the value of firm A, you will know how much we can pay to firm B, and that way you can do. The institute has done it like that. Second question. What is the minimum exchange ratio acceptable to shareholders of D if the P ratio of the combined firm will be 9 times? Okay, so firm B, if you are the shareholder of firm B, you are presently holding a share, firm B, okay, beta, minimum exchange ratio. So you are presently holding a share worth PB. after merger you will hold not one share but beta shares. So the equivalent post-merger price for firm B is exchange ratio into the post-merger price of the combined entity. So beta into PAB equal to PB. Now the same stuff, beta into P ratio into EPS is equal to PB. What is the price of firm B? 15. It's given. 15. 15. So we get beta into 9. This time the P ratio is given 9. 90 plus 30, 96 plus 30 divided by 20 plus 14 beta is equal to 15. Solve for beta. Okay, I had done. Check your copy. 2 or 3 sums in your copy on this model on computation of alpha and beta if post-merger P ratio is given. So very straightforward. One would love it. Okay, if the question reappears in the exam. And if you can't solve basic algebra by moving right and left, in that case, nobody can help. Okay, perfect. So question number 5 is over. We move to question number 6. Long is planning to acquire Toll with the following data. So we are given the expected EPS E1 and E1, expected DPS and D1. I remember when the sum came originally with a different name, that time it was just written EPS and DPS and there was a whole lot of confusion whether this is E0 or it's E1. Here it is clear. Number of shares 30 lakhs, 18 lakhs. Current market price 180 and 50. As per an estimate of Toll Limited, Toll Limited is expected to have steady state growth of earnings and dividend to the tune of 6% per annum. Okay, so growth rate of Toll 6% per annum perpetually, D1 by RE minus G. However, under the new management, the growth rate is likely to be enhanced to 8% per annum without any additional investment. Now that's a source of synergy. We will make the growth rise from 6 to 8 without putting any money and without any change in risk. So therefore, there's a creation of value over there. You are required to calculate the net cost of acquisition by Long Limited if 60 each paid for each share of Toll. So if we are paying, net cost of acquisition or true cost of acquisition, it refers to how much extra we are paying to the target company as compared to the market price of the target company. So in a cash deal, look, we are paying 60, but what is the market price of Toll? 50. So how much extra we are paying? 10. And how many shares they have? 18. So 10 into 18, 180 lakhs is the answer. The first part, we don't have to value anything, no synergy, no nothing, because it's a cash deal. So how much extra are you paying to the other company? You are paying 60, the price is 50, you are paying 10 extra into 18. 180 lakhs will be the answer, no matter with what stupidity they might have done. Yeah, 180 lakhs is the answer. Second part, if the agreed exchange ratio is 1 share of Long for every 3 shares of Toll, okay, 1 share of Long for every 3 shares of Toll, in lieu of the cash consideration as per one above, what will be the net cost of acquisition? So once again we have to do the net cost of acquisition, but this time it is a stock deal. So what are we paying to short? That depends upon what shall be the post-merger share price. What shall be the post-merger share price? So post-merger share price we have to calculate. For this we have to first of all calculate synergy. So synergy in DDM is calculated this way. For Toll, RE or KE is D1 divided by P0 plus G. So RE is equal to, what is the D1 for Toll? D1 for Toll is 3. Okay, and G is 6% right now, pre-merger. 3 divided by what's the price? The price is 50 plus G is 0.06. So required rate of return is coming to, I think, 7.5%. Sorry, 12%. 12% is the required rate of return. Now, since the risk complexion is not changing. Therefore, required rate of return will remain the same, but the growth rate will become what? 8%. So we have to find out the new price equal to D1 by RE minus G. So D1 3, because it's already given. I have taught you in equity valuation that if expected dividend is given and growth rate changes, D1 will not change. Okay. If D0 was given, I would have computed new D1. But if D1 is given, we should not change. I'll check the answer whether they've changed or not. Otherwise, I will cut my answer because we have to follow theirs. 0.12 minus 0.08. So it's 3 by 0.04, which is 75, I think. Divide by 0.04, 75. So 75 becomes Toll's price, and the price of Toll was 50. So the value of synergy according to me is 75 minus 50 into 18 lakhs, which is 25 into 18 lakhs. 450 lakhs is the value of synergy. Surprisingly, I think they have asked this in the third part of the question. 450 lakhs. In the third part, gain from acquisition. Let me check the third part. Is it 450 lakhs? Yes, it is 450 lakhs, no matter how they calculated it. 450 lakhs. So, in the second question, we were doing, so, what is the value of A? The value of firm A is number of shares into share price, which is 30 into 180. 30 into 180. That is 5400 lakhs. 5400 lakhs. 5400. What is the value of B? The value of B is number of shares into price, 18 into 50. 18 into 50, I think it's 900 lakhs. And what is the value of synergy? It is 450 lakhs. So value of the combined firm VAB is equal to VA plus VB plus synergy. So it's 5400 plus 900 plus 450, which comes to 6750 lakhs. 6750 lakhs. So share price after merger, price AB will be 6750 divided by combined number of shares. Combined number of shares, we have 30 lakh shares of long, and we are issuing one share for 3 years, 3 shares, so 1/3 of 18, 6 lakh shares for the other company. 30 plus 1/3 of 18. Okay, 30 plus 1/3 of 18, that is 6 lakh shares we are issuing. So price after merger will be 6750 divided by 36. 6750 divided by 36. This comes to 187.5. So 187.5 you are paying to that company. 187.5. You are issuing 6 lakh shares valued at 187.5. So what is the net cost of acquisition? It is 6 lakhs into 187.5 minus the value of firm B, which is 18 lakhs into 50. Understood? Net cost of acquisition is the extra you pay to firm B. So you are issuing 6 lakh shares worth 187.5 minus 18 into 50. What is it coming to? It's coming to 225 lakhs. So 225 lakhs is the net cost of acquisition. Remember, net cost of acquisition is whatever you are paying minus the value of firm B. Value of firm B is 18 into 50. And what you are paying is 6 lakh shares worth 187.5. Okay. There is also a word called apparent cost of acquisition. Apparent. In apparent cost of acquisition, instead of this 187.5, we take our current share price. What was the current share price? The current share price was 180. So it's like you are issuing 6 lakh shares of 180. In that case, what does the answer come to? It is 6 into 180 minus 900. It comes to 180 lakhs. So there are two answers. The correct answer is 225 lakhs, it's called the true cost of acquisition. But if you value the 6 lakh shares at the current price of A, in that case it's apparent cost of acquisition 180 lakhs. Let's check which answer matches. So here we have 225 lakhs, it's matching, and they've also given an alternate answer 180 lakhs. So they've given two answers, true cost, apparent cost. True cost is the best answer. Perfect. So they were the three sums which were considerably new, okay, in this section. So we have completed that. Okay, I'll take another class of mergers to cover up the remaining sums, actually which don't require to be covered. But just because you listen to me at this speed, okay, where I'm not wasting time, it's always better for you, because you're also able to revise and get that tone which we used to have, the rhythm in class. Okay, thank you.